Hey traders, welcome back. So this is a gold. I'm going to talk about the entry confirmation in the market. So I'm using gold for our time frame. I want to give you an example here. So when you look at gold, it was retracing from here, going bearish, and then it retraced back to this 4 hours fair value gap here. So when you look at these candlesticks, we have these the imbalances that we have this one. This is a breakaway gap. This one also is a breakaway gap, and then here we have a fair value gap. So if you don't know the difference between breakaway gaps and fair value gap, you can check on my channel. Have a video concerning the breakaway gaps and fair value gaps. So we have this one. This is the fair value gap that I'm talking about here. So that is the fair value gap. That one there. When you look at this fair value gap, when you look at the first, we consider this one as the first candlestick, this one is the second candlestick, and then this is the third candlestick. The third candlestick is closing below the second candlestick. So this one gives us a high probability of the price retracing back to this imbalance, which is a fair value gap, and then it went down to collect liquidity here. So I want to break this trade here. We are looking at 4 hours fair value gap. If you're using 4 hours fair value gap, you have to go to 15 minutes time frame for confirmation entry. So let's go to 15 minutes time frame and see how to enter the trade. So we have this is where the retracement took place. So this is our fair value gap, that one. So when you look at this retracement, the retracement started from here. The retracement started from here. We can see there's no any liquidity swept below this point, and then we had you have to find the last break of structure here. So the break of structure happened here. This one is the break of structure. So when we have this one and then we have this one, after the break of structure, now we know we are looking at this movement here, this one. So that one, you have to take your Fibonacci, and then we measure this from here and then to here. I think it's somewhere there. Yeah, there. So that is Fib. So when you look at Fibonacci, the first thing we want to look at is 50%. 50% is here. Let me use another line so that we see it clearly. That one. That is where we have 50% of this movement here. So whatever is down here, it is none of our business. We are waiting for the price to cross the 50% or tap inside the 50%. So we had this. We had all these liquidities being formed. We have liquidity here, here. All these are just liquidities up to here. So the first time that the price touched the 50% was here. And when we look at this point here, let me enlarge it. When we look at this point here, we had the price went and then came back. So first, in this movement here, we had this fair value gap here. This one. So the first thing, when the price touched the 50%, we wanted to see the reaction at this point. This is a point of interest. It is a fair value gap. Those who are scalping can use this one as the point of interest for buys. So you want to see the reaction of this, what is going to happen at this place. So what happened, the price came, tapped inside that fair value gap, and then it pushed up. It tried to come back, but it failed again, pushed up to clear liquidity here. So this was another clear sweep of liquidity. It is run on liquidity. So we had that. It came, tapped inside here and back. So you cannot use this one. We could have considered this one if the candlestick came and closed below this fair value gap here, somewhere here. So it came, sweep liquidity, and then let us see what happened here. So we want to look at this movement here. The price came, you can see even the momentum that it started with here. It swept the liquidity up here, and then it began to retrace back. So we had this imbalance, and then we had this imbalance. So I want to mark those two imbalances. The first one is this one here. We had that imbalance, and then we had this smaller one here. This one was very small there. It was a fair value gap. So this one, between this one and this one, this is the fair value gap. This is a breakaway gap. This is a breakaway gap because we are forming another imbalance. After this, we have this one. So this is a fair value gap because when you look at the first candle, second, and then the third is closing below the second candlestick. And then what we had to do for the confirmation, you had to wait for the price to come back to this place here, this fair value gap. And also that before even we come to that, there was this fair value gap here. In this movement, this one, this fair value gap was created. We have that, it was created. So when it was created, when the price started coming back, it closed below that fair value gap. It did not react to this fair value gap. So we had 2 points of interest. You can either use this one is now an inverted, the bigger one. This one is inverted fair value gap. And then we have this small one, which is the fair value gap. So you could have used either the inverted fair value gap or this one here, the smaller one. So when you use that smaller one, we have to put our entry here at the beginning of that fair value gap, and then we push our stop loss to somewhere here. You can even cover that breakaway gap like that, and then we are holding this price until it sweeps the liquidity. Immediately sweeps the liquidity, you get out of the market like that. So that is how this trade went, and it came until the TP was hit. So this is one of the best trade this week. If you saw the trade and got something out of that trade, so that is how you are supposed to trade. So normally consider the inverted fair value gap and the fair value gaps when you're entering a trade. In that way it is easier. And also another thing, when you're looking at 50%, normally if there is another point of interest, let's say an order block or another fair value gap above the 50%, then expect the price to come to that point and then react to that point. So that is how you are supposed to consider the trades. Mostly do not trade if the trade has not like here we are selling, so we have to sell out the premium. You buy at discount. So if you are selling and the price has not reached the premium, you don't buy. Just wait for the price to reach the premium and then look at the confirmation and then enter the trade. I think with that is it's not that difficult. You just need patience in this market. If you have patience, then you are good to go. So we have these two confirmation. You can either use liquidity to enter the market, or you use this confirmation, the confirmation using the fair value gaps. So you can use those two. I'll make another video concerning how to enter the market using the liquidity. But you can also use the liquidity I've talked about. Entering the trade using liquidity, you can check on my videos. So see you in the next video.